The Minority Market. Episode 57. How to Combine Fundamental and Technical Thinking. Most people believe they must choose one side, either fundamentals or technicals. They argue endlessly about which approach is superior. This debate itself is a trap. The minority does not choose sides. The minority integrates. They understand that fundamentals explain what to buy or hold, while technicals help decide when to act. When these two perspectives work together, decision-making becomes clearer, calmer, and more structured. Fundamental thinking is about understanding the business behind the stock. It answers questions such as, is this company creating real value? Is the business sustainable? Is management capable? Does the company have a competitive advantage? Fundamentals give direction. They help you avoid weak businesses and low-quality opportunities. Without this foundation, you are simply trading symbols on a screen instead of investing in real economic activity. Technical thinking, on the other hand, reflects behavior. Price movements represent the collective decisions of millions of participants. Charts do not predict the future. They reveal current sentiment, supply and demand imbalance, and market psychology. Technical analysis helps you understand timing, risk zones, momentum, and confirmation. It does not replace business understanding, but it adds structure to execution. The mistake beginners make is using one method blindly and ignoring the other. Fundamental-only participants often buy good companies at bad prices and hold through unnecessary drawdowns. Technical-only traders often chase momentum without understanding what they are buying. The minority avoids both extremes by combining context with timing. Think of fundamentals as your compass and technicals as your map. The compass tells you the general direction you should travel. The map tells you the safest and most efficient path to get there. Without the compass, you may walk fast in the wrong direction. Without the map, you may walk slowly and get lost. A practical way to integrate both approaches is through top-down thinking. Start with business quality and long-term potential. Narrow your watch list to companies or sectors that show strong fundamentals. Then use technical analysis to decide entries, exits, and risk management. This structure prevents impulsive decisions and emotional chasing. Another important integration principle is alignment. When fundamentals and technicals support the same direction, probabilities improve. For example, a strong business showing steady revenue growth combined with a price structure forming higher highs and higher lows creates alignment. When both logic and behavior point in the same direction, decision confidence increases without emotional attachment. Risk management becomes stronger when you integrate both perspectives. Fundamentals help you avoid fragile companies that collapse under stress. Technicals help you control downside through stop placement and position sizing. Together, they protect capital. Remember, survival always comes before growth. Long-term participants benefit greatly from this integration. Fundamentals guide long-term holding decisions. Technicals help avoid buying at emotional peaks and help manage re-entry after corrections. Even investors who do not trade actively can use technical awareness to improve timing and reduce psychological pressure. Another advantage of combining both methods is emotional stability. When you understand the business, you panic less during short-term volatility. When you respect price behavior, you avoid emotional attachment during trend changes. This balance creates mental clarity. The minority also understands that integration is not about complexity. You do not need dozens of indicators or complicated financial models. Simplicity works best. Clear business logic combined with clean price structure is enough. Overcomplication creates confusion and emotional dependency. One powerful habit is confirmation discipline. Before entering a position, ask yourself, do the fundamentals justify interest? Does price behavior support action? If both answers are not aligned, wait. Waiting is a skill. Patience protects you from forcing trades or investments out of boredom. Another important concept is adaptability. Markets change. Sometimes technical signals dominate short-term movements. Sometimes fundamentals drive long-term trends. The minority stays flexible. They adjust behavior based on conditions instead of rigidly following one method. Integration also improves learning. When a trade fails, you can analyze both sides. Was the business weak? Was the entry poorly timed? Was market sentiment shifting? This deeper reflection strengthens future decision-making and reduces repeated mistakes. Over time, combining fundamental and technical thinking builds confidence based on understanding, not ego. You stop reacting to noise. You stop chasing opinions. You start building your own framework. This independence is one of the strongest advantages in markets. Remember, the goal is not to predict perfectly. The goal is to improve probability and manage risk. Integration does exactly that. It increases the quality of decisions and reduces emotional mistakes. The majority argues about methods. The minority builds systems. They do not worship fundamentals. They do not blindly trust charts. They use both as tools, not as beliefs. This mindset shift alone puts you ahead of most participants. As you move forward, practice observing both business logic and price behavior together. Train your mind to see alignment instead of conflict. With time, this integrated approach becomes natural and intuitive. Markets reward clarity, discipline, and preparation. When you combine understanding with execution, patience with structure, and logic with behavior, you begin operating like the minority, calm, strategic, and consistent. This integration is not a shortcut. It is a long-term skill. But once developed, it becomes one of the strongest foundations for sustainable market participation.